one of our guest speakers, and really the author of the only truly kind of helpful book in this space, Advanced Portfolio Management, Giuseppe Paleologo, who's now the head of risk management at Bally, told us 20 years ago, no fundamental stock picker was thinking about factors. Today, many stock pickers are thinking about factors. In a few years, all stock pickers will be thinking about factors. The others will have gone extinct, and that might embed a little bit of hyperbole in it. But I've really had a front row seat for the last 15 or 20 years and seeing the evolution of the orientation around factors as a chassis for the institutional asset management industry. And so really, to dig a little bit deeper into that, we kind of think about three dominant trends in equity markets. One is the kind of well-known, well-understood trend of indexation and the shift to passive from active, of cheap beta, and the reality that 70% of long onlys have underperformed the S&P, and this really orthodoxy amongst many investors, both retail and institutional, that it's very hard. You can't beat the S&P 500. That has really led to a tectonic shift in allocations to indices. Two, part of passive or passive light or active light or thematic and factor-based ETFs. And candidly, before the development of this program, I knew this was a big industry, but I didn't realize that the thematic and factor ETF world, the thematic investing world, was roughly equal size to the long-short equity world, roughly a $2 trillion industry. The amount of capital has gone into factor-focused strategies, whether they be value, momentum, low volatility, the proliferation of both smart beta products, but also portable alpha strategies that are really making a resurgence. So we talk about some of our guest speakers, really understanding that who's on the other side of the trade matters a lot. We talk a lot about that as fundamental analysts and PMs, and understanding that more and more who's on the other side of the trade is the indexer or the factor ETF or the factor quant. And so understanding these different players at the poker table can be important. Three, and this is more topical for many of our folks, is the rise of the multi-manager space, having gone from a $90 billion industry to a $300 to $400 billion industry now, and really has been the incremental source of new AUM in the hedge fund industry, and certainly the incremental source of new seats, new investor seats. A typical mid-sized Tiger Cub might have 8 to 12 people on the investment team. That's the size of one decent pod at one of the big four pods now. And so just the sheer number of investment seats really means that for those of us looking for a career in this industry, more often than not, whether we like it or not, the incremental employer tends to come from these large complexes.